Have you ever heard the term arbitrage? Arbitrage is the expression of the concept that many banks and investors do where they borrow at a lower cost and take the capital borrowed and invest it in something that has a higher rate of return than their cost. That difference, the potential profit, is what arbitrage is trying to describe. In this video, I'm going to discuss this concept and how it applies to investment real estate. And this example came as an inspiration from a conversation I had just over a week ago with a potential client. You see, the client was referred to me by a realtor, and they were wanting advice as it related to whether they should keep the present property they had or sell it in order to be able to buy something else. You see, the house they lived in, they bought about 3 years ago. They had locked in a great price on the house back then. They locked in an awesome interest rate, I think somewhere in the threes. And they just felt like if they sold the house and paid off that mortgage, they could be losing some opportunity, because that kind of interest rate, as they know, perhaps you as the viewer have a similar interest rate, and you know that interest rate may never come around again, and that opportunity will have been lost. So we looked at the concept of applying arbitrage with regards to that awesome mortgage rate, keeping that house, converting it to an investment property, and upgrading and buying something that was a little bit bigger and a little bit more comfortable and more ideal for his family needs today. So stick with me as we go through this video. I'm going to share with you the same illustrations to exemplify the power of real estate arbitrage and the impact of owning investment real estate can have for people financially. By the end of it, I think you'll agree with me that there's a reason why there are more millionaires made in the U.S. through ownership of investment property than any other asset class. So as I mentioned, I was talking to this couple who owned a property that they bought in 2019, locked in an awesome mortgage, and now they're trying to figure out exactly what owning this home would be like if they wanted to keep it and convert it into an investment property. So I built this sort of illustration for them to be able to exemplify what a nicely arbitraged real estate investment would mean for them. So in their case, like I said, they bought a house, it's now worth more money. And so we made the assumption that the house might be worth $420,000. And that's based off of a home that I found in the area that was kind of similar to theirs, a 3-bedroom, 2-bath, West Eugene home that was presently offered on Zillow. Then we took into account their mortgage. Well, they're about 3 years into this mortgage, and by the time they were to convert this home into investment property, they might be very well in the very start of their 4th year. And if that were the case, on a $275,000 mortgage locked in at 3%, their principal and interest payment of their mortgage would be right around $1,239, of which their principal portion of that payment would be $552 if we round up a few cents. Now, as we know, when you own investment real estate, it's not just about how much money you receive after making the mortgage payment and covering operational expenses. It's also how much of that mortgage payment is being paid towards principal. That's one of the big wealth generators for investment real estate. And in fact, if you go back, there we go. If you go back here, you could see here on the 12th month of paying on this mortgage, a total of $6,700 will have been paid towards the principal of the mortgage. After 2 years, it would have been $13,600 of principal paid on that mortgage. So we're constantly building more and more momentum by the more principal is being paid down on that loan. And, essentially you can think about it, the more money you pay towards principal, the more money that's being saved in that home. Because sure, principal paid toward your mortgage isn't money you get in your pocket today. It's money that you'll get in your pocket if and when you sell that home in the future. So it's a big piggy bank. And also, we took a look at homes in the area and what they would go for rent. Around there, it might be as much as $2,200 a month, as featured by another rental property that's present in the market in Zillow that's being offered for $2,200. Of course, maybe for our rental analysis and our operational cost analysis standpoint, we don't want to assume top dollar rent year in and year out. So what I did for mine is I started the rental analysis with the assumption that we're getting about $2,100 a month in rent. And that way, between the rent and assuming that we're going to only be occupying this house and collecting rent about 95% of the time in a 5 and 10 year window period, we can take into account that there's going to be some vacancy gap between one tenant leaving and a new tenant coming in. We don't have to take, we're also taking into account that we're not getting the maximum top dollar in rent. We're being a little conservative. And also in our operational cost analysis, we're taking into account that there are going to be other costs to owning the investment property besides just the mortgage. I mean, many landlords don't like to deal with tenants directly and rather outsource the management of the property to a property management company. And that's fine. But you got to figure that a property management company is going to take anywhere from 8 to 10% of the rents. So in this analysis, we assumed that the property management company was taking about $2,400 a month of the rents for themselves as part of their cost of managing the rental property on an annual basis. Additionally, there's going to be some legal fees and there's going to be repairs and maintenance. All those things might add up to, anywhere from $950 a year for property for maintenance and repairs. I think that's a fair number to think of for an assumption because, hey, every 8 to 10 years, you got to repaint the house. Every 25 to 30 years around here, you got to re-roof it. Those are costs associated with maintaining the home. And every home's going to have to have insurance, right? I mean, in case the house burns down or something, you want to make sure that you can repair it and replace it. And for the particular house that was up for sale, it was on the higher side for property taxes at $4,700 a year. Again, that's a little high, but I thought, hey, let's be conservative and let's show the higher side. Because again, if we're assuming higher things on the cost and a little bit lower on the gross rents we're receiving, that will be a very conservative analysis that we're going to put together for our prospective client. In the grand scheme of things, after the mortgage is paid, some of it towards principal, after covering the other overhead, in this analysis, it might just be that the very first year, the prospective landlord would only net $158 in net cash flow that they could put in their pocket. Doesn't sound like much, right? But again, remember, a lot of wealth is going to be generated by the amount of money that's going towards principal. In my analysis, I made a few assumptions. I made the assumption that over the course of 10 years, the home's going to appreciate by 5%. Why 5%? Because in Lane County, Oregon, it's very typical for any 10-year period of time, going back to the 70s even, that any 10-year window period of time that you pick, the homes have averaged about between 5 and 5.5% appreciation. Sure, there are going to be some years where you're going to get more than 5% appreciation, like we've seen back in 2020 and 2021. But we're also going to see years where we don't get any appreciation and maybe some depreciation, like maybe what we saw a little bit in 2022 and entering into 2023. But in the grand scheme of things, 5% appreciation is a very typical and safe number to assume for our analysis. And rents, they go up in lockstep with home valuations that appreciate. So if homes go up by 5%, it's safe to assume that the cost of rent is going to go up by about 5% a year as well. And also for our analysis, we made the assumption that the expense of maintaining a home, the property management fees, the maintenance, the other things, taxes, insurance, those are going to go up by about 3% a year, which has kind of been historically average for our area. So what does that mean in the course of a 5-year period of time of owning an investment property, such as in this analysis, and versus 10-year analysis? Well, the numbers are pretty staggering. So in this scenario, again, we've got somebody who's got about $145,000 of equity trapped up in their property, and they've got a super low interest rate. And again, we've made some conservative assumptions about the operational rents and cost for owning that real estate. But over the course of the first 5 years, in this scenario, the landlord would have generated $45,000 in cash flow, net cash flow, and principal paid towards their mortgage. It's a big number. And then in terms of appreciation, the home's value would have increased by $116,000 if it only appreciated by 5% a year. In total, it's expected that this house could return $161,000 in net profit for this potential landlord. Compare that to the $145,000 they've got trapped up in that property. That's like doubling your money, right? Now look over the course of 10 years. In 10 years, the total amount of cash flow, principal paid would have added up to almost $125,000. Additionally, they would have seen the house gone up in value by over $264,000, meaning that over the course of 10 years, they might see a total return on their investment of almost $389,000. Now again, compare that to the $145,000 they got trapped up. Now, another way you could think about this too is that what if you had $145,000 that you was sitting in your bank account and you were debating where to invest it? Do I put that money towards buying an investment property, or do I put that money into maybe mutual funds and stock market investments, right? You know, are you going to be able to more than double your money in a 10-year period of time? Let's take a look. So what if you'd had that $145,000 instead of, invested it into real estate? What if you put that into the stocks, mutual funds, and so forth? Well, most investment advisors will tell you that in any 10-year period of time, the stock market, the average person invests in the S&P 500 in a well-diversified investment account would be happy to see a 10% rate of return on their investment. However, few people really take into account the fact that these investments, these mutual funds, they have expenses and overhead that they have to cover, as well as paying the financial advisor, right? So oftentimes, these mutual funds and investments, they have operational costs that they pass on and take from those returns that can be anywhere from 1.5% to 4% of the total return on the investment, meaning that you're not getting truly a net 10% return on your investment. Maybe you're getting 8.5% like this analysis does. And if you got 8.5% on a $145,000 investment over 10 years, you might see a net gain of $183,000. $183,000 over 10 years on $145,000, or a $389,000 return on properly leveraged, well arbitraged investment real estate asset. You be the judge. Which one do you feel like you understand more? In the case of the prospective clients of mine, I asked them that question. And I said, hey, how well do you know the investments that your 401k and those mutual funds are invested into? Do you understand intrinsically why each of the 500 companies that make up the S&P 500 mutual fund investment, why they go up in value, why they go down? Have you ever really looked through your portfolio and analyzed each of the individual investments? Do you fully understand what you're invested in and why these things are as volatile as they are? And that you're confident that they'll go up in value over the next 5 and 10 years in the way that maybe your investment real estate would. On the flip side, how well do you know your investment real estate? Well, in his case, he lives in it. He knows the asset is better than anybody ever would because him and his wife live in it. He also understands the marketplace. In our area, they haven't been building enough single-family homes for the last 10 years. So there's a huge amount of pent-up demand. There are more people that want to buy and own homes like his than there are homes available for sale. And that will continue to be the case for many, many, many years. The same is true as it relates to a rental property in our area. He knows that there are more people that want to rent these homes than there are rental homes available. So that's a very strong indication that there is, when you have more demand than there is supply, that's very favorable for people that own that type of asset. And so at the end of the conversation, what he basically came to the realization is that there was extreme value in owning investment real estate. And if he did convert his present home into an investment property, it could mean a huge added value for him in his retirement planning and his ability for his family to grow their wealth over time in a way that just can't be matched with any investments he presently is aware of in his 401k and other endeavors in investing in mutual funds, in stocks and bonds. Anyway, I hope this video has been of value to you in examining and exploring the value of real estate arbitrage. And maybe you now understand why so many millionaires, far more, have been created through the ownership of real estate investment than in any other value asset class throughout the United States. Thanks for watching.